Before we go any further, it's important to understand what people actually mean when they talk about a market bubble. A bubble forms when investors become convinced that prices can only move higher, optimism spreads quickly, more money pours into the same assets, and rising prices attract even more buyers. At first, everything looks perfectly normal. Companies report strong growth, headlines stay positive, and people begin believing that this time is somehow different. But history shows that markets don't climb forever. Eventually, valuations become disconnected from reality. Expectations grow far beyond what businesses can realistically deliver, and once confidence starts fading, prices can reverse surprisingly fast. Based on historical patterns, we are approaching a stage where many of today's biggest winners could face significant corrections. The companies that have experienced the most explosive growth, especially those tied to artificial intelligence and other highly popular sectors, are often the most vulnerable when market sentiment changes. A decline of around 70% may sound shocking, but it wouldn't be something financial markets have never experienced before. Investors often forget that major stock indexes have suffered similar collapses in the past. During the dot-com crash, the Nasdaq lost roughly 82% of its value from peak to bottom. At the time, many believed technology companies could only keep growing. Yet, reality turned out very differently. Another powerful example comes from Japan in the late 1980s. Back then, Japan looked unstoppable. Its technology companies dominated global markets, its manufacturers were outperforming international competitors, and Japanese products had built an incredible reputation for quality. Investors became convinced that Japan represented the future of the global economy. Stock prices climbed to extraordinary levels, with company valuations reaching numbers that were difficult to justify based on actual earnings. Compared to previous American market bubbles, Japan's stock market became even more expensive. Then everything changed. Instead of quickly recovering, the Japanese market entered a prolonged decline that lasted for decades. Many people refer to it as Japan's lost decade, but when economists studied the numbers carefully, the economic slowdown lasted much closer to 20 years. That example reminds us that market recoveries aren't always immediate. So what does all of this mean for everyday people? When financial markets experience major declines, the effects extend well beyond investors. Companies whose stock prices collapses often reduce costs by slowing expansion, freezing hiring, or laying off employees. At the same time, households begin feeling less financially secure. When investment portfolios grow, people usually become more comfortable spending money. But when those portfolios suddenly shrink, consumer confidence weakens, families cut back on discretionary purchases, businesses generate less revenue, and economic activity begins slowing across multiple industries. History shows that major asset bubbles have often been followed by difficult economic periods. The stock market crash of 1929 was followed by the Great Depression, one of the most severe economic crises in modern history. While many different factors contributed to that disaster, the collapse in financial market played a major role in triggering the downturn. Another example appeared during the early 1970s, when a group of America's most admired corporations became known as the Nifty 50. Investors believed these companies were so exceptional that their shares could be purchased at almost any price. Eventually, those stocks also experienced dramatic declines, and the economy entered one of its deepest recessions since the Great Depression. If history teaches us anything, it's that excessive optimism rarely lasts forever. So how should an average investor prepare? One of the oldest principles in investing remains one of the most effective: diversification. Diversification simply means avoiding the mistake of putting all your money into a single investment or a single sector. Instead, a balanced portfolio can include stocks, bonds, cash reserves, gold, silver, properties. The idea is simple. When one asset struggles, another may provide stability. Many people hear the word bond, but aren't exactly sure what it means. In simple terms, buying a bond means lending your money to someone else in exchange for regular interest payments. The borrower could be a government or a private company. If it's a government bond, you are effectively providing funds to the government, which promises to repay you with interest over a specific period. Governments issue bonds with different maturities ranging from a few months to several decades. Investors receive fixed interest payments as long as the borrower remains financially reliable. Corporation bonds work in much the same way. Instead of lending money to a government, you are lending it to a business, which is very risky, which agrees to pay interest until the bond reaches maturity, or you will get nothing if it goes bankrupt. Today, investors can purchase both government and corporate bonds through many traditional brokerage platforms, making them much more accessible than many people realize, which is very risky. While no investment is completely risk-free, diversification across multiple asset classes has historically helped reduce the impact of severe market downturns. But bonds will become worthless when the US goes bankrupt, and the same will happen to corporate bonds. They will simply be worth nothing. If you are interested in bonds, most investment platforms have a dedicated fixed income sections where you can browse available government and corporate debt. One thing many beginners don't realize is that in most cases you are purchasing an existing bond from another investor rather than lending fresh money directly to the issuer. Here's how it works, which is very risky. When a government or company first issues a bond, it raises capital by selling large amount of debt to investors. After that initial sell, those bonds begin trading on the secondary market, where investors buy and sell them among themselves. Because of that, the prices you pay usually isn't the same as the original issue price. Depending on interest rates and market demand, a bond may trade above or below its face value. Some bonds become more valuable over time, while others can be purchased at a discount. The interest rate attached to the bond, often called the coupon, is fixed when it's issued. In certain periods of history, investors were able to lock in remarkably high yields. During times of elevated interest rates, earnings annually returns of 8%, 9%, or even 10% from high-quality bonds wasn't unusual. And then ask yourself, what is better? If gold is increasing in price by even 40, 30, sometimes 50% a year, bonds are not performing well. Gold and silver is performing 10 times better. Today, government bonds generally often lower yield, but they can still provide a relatively stable source of income compared with more volatile investment. Corporate bonds may offer slightly higher returns because investors take on additional risk by lending money to businesses instead of governments. For many investors, bonds aren't designed to generate explosive growth, like gold or silver. Their primary purpose is to add stability to a portfolio and reduce overall risk during periods of market uncertainty. However, this is really only a good option for people looking to invest large amounts of money. Who has less, then maybe gold and silver is better consideration. Of course, it depends on your financial means and circumstances. Another asset that people often consider is real estate. The challenge is that property prices in many countries remain historically expensive. Over the past few decades, housing has become dramatically less affordable for first-time buyers. In previous generations, purchasing a home required a much smaller multiple of families' annual income. Today, in many major cities, that ratio has increased several times over. As a result, many young families struggle to qualify for mortgages or save enough for a down payment. Rising property values have also pushed rental costs higher, making housing more expensive where you own or rent. This isn't just a problem in one country. Similar affordability issues can be seen across Europe, Canada, Australia, China, and many other developed economies. Instead of moving in line with wages, home prices have risen much faster for many years. Even if housing markets were to experience meaningful corrections, properties would still remain expensive compared with long-term historical averages. A decline alone doesn't automatically make housing affordable again. That's why diversification remains such an important principle. Rather than concentrating your wealth in one investment, spreading it across different asset classes can help reduce risk. Investors should also think beyond a single country's stock market. One argument often made by value-focused investors is that some international markets currently appear more attractive priced than US equities. In recent years, several overseas markets have even outperformed American stocks over certain periods. That includes shares from developed economies as well as selected emerging markets. The reasoning is fairly straightforward. When prices become excessively high, future returns often become less attractive. Paying too much for even an excellent business can lead to disappointing investment results. History has repeatedly demonstrated this relationship. During the technology boom around the year 2000, US stocks reached extremely expensive valuations. Investors who bought near the peak often waited many years before seeing meaningful gains again. In some cases, an entire decade produced little or no really return after inflation. That's why valuation matters just as much as the quality of the companies themselves. Expensive market can remain expensive for a while, but eventually expectations tend to reconnect with economic reality. Japan provides one of the clearest historical examples. After reaching extraordinary valuations in the late 1980s, its stock market entered a decline that took decades to fully recover from. Investors who purchased near to the top faced an exceptionally long wait before returning to previous highs. The broader lesson is simple. Markets occasionally become driven more by excitements than by fundamentals. When that happens, caution becomes far more valuable than chasing short-term momentum. Every investor should accept responsibility for managing risk instead of assuming prices will always continue climbing. It's also worth remembering that many financial professionals rarely encourage clients to leave the market completely. Investment firms generally earn money by keeping clients' assets invested. Because of that, recommendations to significantly reduce stock exposure during periods of extreme overvaluation have historically been relatively uncommon. Looking back to previous bubbles, from the crash of 1929 to the Nifty 50 era and the dot-com boom, many investors remained heavily invested in all the way through major market declines. History doesn't repeat itself in exactly the same way every time, but it often offers valuable lessons for those willing to study it carefully. If you have never invested in bonds before, the process is actually much simpler than most people think. One of the biggest challenges during a financial bubble is that warning people too early can be almost as difficult as being wrong. Markets can continue rising for years after becoming clearly overvalued, and during that period, anyone advising cautious may appear to be making a mistake. This creates a serious conflict inside the investment industry. Many financial firms earn revenue by managing money. The more asset client keeps invested, the more fees those companies collect.